Have you ever wondered whether it makes sense to put 20% down on buying a house in order to avoid paying private mortgage insurance, or PMI? To help you make that decision, I asked one of my go-to lenders for a couple of quotes this morning so that we could walk through an example. Now keep in mind that interest rates and PMI rates fluctuate and will vary based on factors such as your credit score. So these numbers are really just for the purpose of an illustration. Let's assume that you're purchasing a home for $250,000 and you're trying to decide between putting 5% down or 20% down. If you put down 5%, which would be $12,500, your interest rate in this example would be 3.25%. And this would result in a monthly principal and interest payment of $1,033.62. Now on top of that, you're gonna have a monthly PMI payment of $116.77, which brings your total monthly payment to $1,150.39, not including taxes or insurance. Now, if you decide to put 20% down instead, which would be $50,000, your interest rate would actually be a little bit higher at 3.375%. This is a little counterintuitive, but an 80% loan actually represents more risk to the lender than the 95% loan because there's no PMI in place to protect the lender against loss. So in this scenario, your monthly principal and interest payment would be $884.19. So by putting down that extra $37,500 up front, you're going to save $266.20 per month, or about $3,200 per year. A quick look at these numbers would tell us that the monthly savings generated by the additional upfront investment would yield you a return of approximately 8.5%, which is pretty significant for a risk-free return. You may be hard-pressed to find anywhere else that you could put your money to get a guaranteed return of 8.5%. However, something to keep in mind is that the equity tied up in your home is a somewhat illiquid asset, which means that if you ever get in a pinch and need to access that money quickly, your only options would be to either do a cash out refinance or take out a home equity loan, which would involve paying some closing costs, or to actually sell the property, which could result in weeks and weeks of waiting to access those funds. Rather than making a larger down payment on your home, you may decide to keep those additional funds in an easy to access savings account for emergencies, or to invest that money somewhere else that is either more liquid or more likely to generate a higher rate of return for you. This really is a personal decision and there's no right or wrong answer. If you find yourself in this situation, the important thing is to have the conversation with your lender. Ask them to run multiple quotes and multiple scenarios with you so that you can make an informed decision that makes the most sense for your situation. If you have any questions at all about down payments or anything else real estate related, then call or email us today and we'll connect you with one of our top agents. Thanks so much for tuning in, and we'll see you next week.